Hello and welcome to our Q3 webinar, Fed Cuts, All Systems Go. My name is Curt Cumming, and as usual, I'm joined by Currie, Portfolio Manager of the Goodwood Milford Fund and Goodwood's institutional and private client accounts. In Q3, Canadian fixed income markets saw a shift as central banks eased monetary policy in response to progress on inflation targets. This led to a more favorable bond environment with stabilized yields and attractive investment opportunities. This webinar will explore recent economic conditions, the reactions of the central banks to these conditions, and the impact of the Goodwood fixed income mandates. This chart illustrates the year-to-date returns of corporate and government bonds with different maturities. The Goodwood portfolios use flexible investment management styles, moving up and down the credit spectrum and reducing or extending duration exposure as we see opportunities. Goodwood does not manage passive portfolios. Our fixed income mandates manage duration, credit, liquidity, inflation, and reinvestment risks. We manage 3 fixed income mandates for advisors, institutions, and family offices. The Goodwood Milford Fund, which was established in 2006, has delivered a net 10% compound annual return with low monthly return volatility and has won multiple awards since its inception. In Q2, our portfolio's corporate bond focus had shorter duration weightings, which allowed us to outperform the broader market indices over the first 2 quarters. In comparison, during Q3, we extended duration, particularly at the short end of the yield curve. This timely, tactical move has increased returns through price appreciation. Extending duration within the short segment has also increased the yield pickup without significantly increasing risk and has mitigated reinvestment risks by locking in higher yields for longer. Chris, could you please comment on the recent FOMC decision and the market's reaction before and after that jumbo cut?
Sure, of course, Kurt. So this slide, well, it has a lot of information. I believe we can narrow it down by looking at the 2-year line along the left-hand side. All those points on the left-hand side are different points on the yield curve, but let's focus on the 2-year. So in the second column where it says Delta versus the Fed, we see the pre-cut yield on the 2-year was 191 basis points. So that's significantly ahead of the Fed, or another way of putting it, the Fed was way behind the bond market in terms of cuts. So a jumbo cut was pretty much expected. And, of course, that's what we got. That delta following along to the right on the 2-year, a delta with a 50 basis points rate cut dropped to 140 basis points. So on the next slide, which we're going to quickly go to and then bounce back, we set out the yield curve before and after there, so you can see graphically how this looks. But let's go back to the table and want to point out a couple of things that are noteworthy. One, all the movement in the yield curve was at the short end of the curve. So, I think that's important to note that reinvestment risk is becoming very, very significant for GIC holders with a big drop in short rates. But you might ask the question, well, 10-year and 30-year rates didn't really drop that much. Why was that? Well, our analysis, reveals to us that there are probably 2 big issues in play. First one was that I think the long end of the curve, which is very inflation sensitive, perhaps might have thought that a 50 basis point cut was too aggressive by the Fed. They may be embarking on a program, that leads to more stimulus, more economic growth, and that leads to inflation. So hence their, concern over the Fed's policy with the jumbo cut. The second issue would be that as rates are cut at the very short end of the curve, the currency takes, a big impact. So the US dollar has fallen. It's been falling for a while, and a number of forecasters are expecting it to fall further. So if you're a foreign currency investor invested in the US bond market, you're facing losses on your US dollar position. So the expectation of foreigners selling their long bonds and perhaps actual selling, we think has led to that, surprising, have to call it sort of underperformance or under response to the Fed's jumbo cut. But I wanted to go now to, let's look at some economics really as we get into why the Fed cuts. And first thing I want to show is that inflation has come down to the Fed's target. So they are PCE core PCE inflation, which is their preferred target, is trending down towards 2.6%. So that's, become quite satisfactory to the Fed and has led them to focus on their other mandate. They have the dual mandate of low inflation and low unemployment. The employment picture is, becoming a concern for the Fed. So if we look at non-farm payrolls on the next chart, we can see that those are steadily going down. So less each month, less and less jobs are being created. So this data point comes out this Friday, October 4th, and 160,000 is the estimate, which is well within the downward trend. And also unemployment on the next page is released on the same date, and you can see the rapid rise in unemployment. So, we think the Fed is concerned that the employment and the labor situation is weakening in the U.S. and that could have consequences down the road. But we've got confidence that the Fed is going to successfully engineer the rarely seen soft landing. And one of the things that gives us confidence is that we don't see a recession on the horizon. So we've seen strong GDP figures. GDP in Q2 has actually ticked up, and it's ticked up even more if we look at the Atlanta Fed's GDP now forecast for Q3, which comes in at 2.5%. So that's led us to put out a forecast, which this is our internal forecast, and we're predicting another jumbo cut for the November 7th meeting. All the FOMC meetings to the end of 2025 are on the left-hand side. Then we scale back to 25 basis points cuts ending in June 18, which approaches the what the Fed has said they expect the neutral rate of interest to be, where the economy is neither contracting or expanding, which is around 3%. So we see the Fed getting to that target around the second quarter of 2025. And on a quarterly basis, the next page, we summarize those results for the Bank of Canada and the Fed. Last chart I'm going to look at is the holdings of our funds. And Curt noted that we have been moving from shorter duration funds, which were carrying quite high coupons, I've got to say, out the curve now to 10 years plus, which is in long bond world, that's 10 years considered a long bond. It's it's rare for companies except for AA's to issue much beyond 10 years. But go through the coupons, and I think you'll be pleasantly surprised that a lot of these coupons are still carry a 5% rate, and there's quite an attractive amount of income being generated. Some of the mandates have a distribution of 4%, and they're well covered by these coupons. So I'm going to turn it over to Curt to conclude and discuss the other Goodwood fixed income mandates.
So the first fund we mentioned earlier today was the Goodwood Milford Fund. So this is a long-short credit-focused mandate that invests in opportunities that have the best risk and reward for the respective capital structure risk. This fund was launched in 2006 and has won multiple awards for its best returns, but also best risk-adjusted returns. Goodwood's investment grade bond mandate aims to preserve capital and provide a high rate of cash coupon by investing in about 25 investment grade bonds, targeting 100 to 150 basis points above the 5-year governments. And Goodwood's ESG conscious investment grade mandate is invested in a portfolio of very liquid securities from issuers that have achieved good or relative scores in third-party ESG evaluation processes. I should note that Goodwood's compliance regime is characterized by robust government structures, transparent policies, and regular audits to ensure strict adherence to operational compliance and implement our investment management risk policies. For consultants and advisors that are talking to their clients about the Goodwood's strategies, we do publish content to inform them on a regular basis. This includes same-day commentaries of the Bank of Canada, and the FOMC meetings, monthly commentaries on the fund's results, and very detailed quarterly information on the investment portfolio and return attribution. And of course, we do these quarterly fixed income webinars, which do explain our performance results. Please let us know if you'd like to be added to any of these commentaries. And if you have any questions on today's webinar, by all means, just reach out to Chris, myself, or anybody else on the fixed income team. Thanks for listening.